From Founders Financial, this is the Built by and for podcast, partner-to-partner conversations for independent financial advisors. Today, host Stephen Watts, Chief Growth Officer at Founders Financial, sits down with Brad Shepard, CEO of Founders Financial, to discuss how to choose a partner firm and the splash versus ripple of any move. Nearly 1 in 10 advisors changed firms last year, roughly double the historical average. Something is shifting. Here's the conversation.
All right, well, I'm here with Brad Shepard, CEO of Founders Financial. Brad, thanks for stopping back in today and having another conversation with me. I think we've got definitely a poignant topic, definitely a topic well-timed for what's going on. Prepping for this, I was kind of looking at some data, and what stood out to me is that in 2025, we are seeing nearly double the amount of advisors that are leaving their existing firms. Now, some of that's M&A, some of that's wirehouse.
And things aren't under control necessarily, right?
But it's double than what the historical average has been. So close to 10% versus the average historical 4 to 5.
Okay, yeah.
Which is, that's significant. It's not insignificant, right?
Definitely not.
So the conversation we're going to have today is not really just about, the act of changing firms, but it's really the conversation around choosing a new partner, right? And if you are going to make that, if you're part of that 10% that's leaving nowadays, like, who are you going to?
Right.
Like, where are you going? How are you making that decision? Are you going from big to big? Are you going from small to big? Are you going from small to small? Like, what's the decisioning in there? But before we get into all that, just take a moment and give me your thoughts, your perspective of what's happening in this industry right now.
Yeah.
That is, we're seeing this big dramatic change.
Yeah, I think part of it's certainly driven by the M&A activity. And as firms are being purchased and acquired, advisors are being forced to assess things they probably wouldn't have even thought to assess before, and whether they're comfortable with the decision that somebody made for them about where they're going to and what that might mean for their enterprises and their businesses. I also think that, and this is a good thing, at least in my estimation for founders, advisors are really beginning to get tired of what this mass acquisition movement over the last decade, private equity movement over the last decade has done. It has created an environment where scale and profit have become more important than service and care, I think, in a lot of these firms. And so they're realizing that they're not independent other than contractually, that they really are very dependent upon these firms for lots of things. And if that's going to be the case, what's that symbiotic relationship then look like? And so I think advisors are picking their head up and beginning to look around again because, what they always knew isn't, what they want isn't, and they're beginning to explore alternatives for probably the first time in a long time because the nature of scale changed the promise, changed the equation, so to speak.
Yeah, the M&A stuff is interesting, right? Because kind of the point you were saying around, are you really independent, right? On one side, you were just purchased and acquired through an acquisition, right? So in that sense, am I really independent? But you're independent because you can always decide to move afterwards. Absolutely. You have that choice, right? So it's an interesting kind of thought there. So as you're an advisor, and whether you're moving because your firm was just acquired and you don't want to go to the person that acquired them, or you're in a situation that just isn't right. Like, for you, what are you thinking about if you're an advisor? If you were an advisor, what are you thinking about? Say, hey, let me assess. What am I assessing? What am I looking forward to in the next relationship? Like, what are those things?
Yeah, I think the same thing that advisors assess on behalf of the client relationships they serve, they should apply to themselves in this same circumstance and ask themselves the question, candidly, what's most important to them? And from their partner, the reality is every firm is their partner. It's the degree to which they're a good,
how good is that
a silent, or a bad partner, right? Exactly. And so I think it always starts with that simple question, what's most important to them? I think it's forcing advisors to really take stock of their business enterprise, what their ability to continue to serve their client relationships means and how they can scale and grow their practices and have a partner to help them do that with. So I think that probably drives a lot of their thinking about what's potentially most important. And I think service degradation has been a real thing in the big firms. And so they're understanding that it's hard to get answers. It's hard to get clarity. It's hard to, get the things they need to make their business decisions by. And so I think it starts there. What's most important? Then it's probably the right way to go about it, but then why is it so important, right? So not just what is, but why is it? And then once you've answered those points, what are you going to do about it? How are you going to then engage this process to discover what's possible? And I think, candidly, the choices is stark in a positive way as it's been in a long time. You've heard me say this before. I think technology has flattened the scale proposition of the big firms, and smaller firms can deliver what the big firms have always claimed to be only able to do.
If they thought about it correctly.
If they think about it correctly, or they spend a legitimate effort in uncovering what's out there versus what they perceive is out there because of the narrative that's been spun in the industry.
If they're trying to build their own tech, then maybe not so much. But if they're thinking about it differently, then
if they see their firm as their interdependent partners, we've talked about on other sessions.
The opportunity to compete has never been greater for smaller firms.
That's exactly right. And so they have legitimate choices. But again, to answer your question, it comes back to what's most important to them, why is it most important to them, and then what does that drive in them in potential openness or desire to change. One of the things I love about our organization and the servant leadership model, its foundation it's built upon, is a tenet of this idea of once you're committed, you go no matter the consequence. And so to what degree of resolve will an independent advisor have in this process to uncover, discover, and then actually pursue rigorously and aggressively what they, at the end of the day, probably deep down knows better for them. And so how much has complacency set into them, to their firm, and what are they willing to do, kind of no matter the consequence, to actually go work with a partner that's going to help them and be specifically focused on helping them achieve their enterprise goals and dreams.
I would imagine that resolve can be challenging, and let me explain why, right? Mm-hmm. Because as the sea, so to speak, becomes very similar, mm-hmm. right? The sea of sameness, for example, right? Yeah. As that becomes more homogenized and more consistent, then the resolve of what really matters probably isn't like as easy to find, right? You don't see it as much. Like, mm-hmm. hey, I really want this, but if that is not clearly visible in the granular landscape,
and maybe not even believe it exists.
Yeah, correct, right? So if you are truly resolved that you need this one thing, then that should be your North Star to go finding that at the right partner, whether they're big. And the bigs do great stuff. And we've talked about that. This is not a knock on bigs or a knock on smalls. They all fill their role very, very well.
This is an effort to understand the differentiation of those choices.
But it's that resolve to go find what you really, really need and go seek it out and stay consistent and honest in that pursuit, right?
Mm-hmm. Yeah. No, I think that's right. I saw an interesting article today. So it's interesting. I probably saw this today now. And the argument the article is making is that the next $1 trillion market cap company mm-hmm. isn't going to be one that's technology based. Now, I don't know if I agree with it or not, but that was the premise. And what they were arguing is that the next $1 trillion market cap company is the one that figures out how to do human services the best. Mm-hmm. And that technology is going to become literally like electricity or clean water. You have to have it. It's expected. It is just understood that that's the way things are. And that's not going to be this massive differentiator. And so if this article is correct, and the idea that what's actually of value is the ability for us to engage in authentic, real relationships, supporting this human experience, it's kind of interesting to think about in our industry space, what does that mean? And then for advisors and their potential desire to find the right partner, what does that mean?
Yeah, it's you made me think of something. It's almost like technology and even AI, right? We need to have a whole bigger AI conversation at some point. That it becomes a utility, right? It becomes the default setting, right?
Yeah.
And it's the table stakes, whatever else you want to throw on there.
Right.
Like it's going to sit as this foundational layer. But to your point, who can do the human services better, right? Who can develop those relationships? Who can understand what is not common amongst the things that are all common, right? In our world.
Yeah, I read an article 15 years ago now, an Indian immigrant to the United States wrote about what makes America great. And as I was about to read the article, I'm expecting to hear things like freedom and separation of church and state, the principal foundations of our country, right? Yeah. And he didn't write about that. He wrote about clean water, that when you flip the switch on in the wall, the electricity goes on, that our roads are drivable. These various things that we just, as Americans, take for granted. I think our industry is going to, in the next 5 to 10 years, and again, back to seeking the right partner, these things that are maybe in the past differentiatable to some degree, they're going to be just taken for granted because everybody has them. Yeah. That's the outcome of the technological revolution, the fintech disruption, AI, all those kinds of things. And so advisors, as they then pursue this question of right partner, are going to have real legitimate choices and how businesses have decided to prioritize experience, relationship, care, listening and understanding, partnership in a way that I think is going to be really neat for advisors in the coming years.
Oh. So the consolidation is happening. We've talked about that, right? The bigs are getting bigger, right? What if you're a smaller firm or a mid-sized firm? Think about the advisor that's got 15, 20, 25 AUM, right? And maybe 60, 80, somewhere in that ballpark. What happens to them? Like, are they lost in this shuffle, or can they get something out of the bigs? Like, should they go small? Like, what should they be thinking about as they seek a partnership, especially if they're rolled up in M&A, right? Because they might be the forgotten child in that situation.
Yeah, we've talked about this a lot, right? They're probably not going to garner much attention. I think it comes back to that same thing we said a minute ago. What's most important to them, and can they exist in those structures? Without question. But do they have the vision? Do they have the perspective to understand that now they're kind of left on their own island? And what are then the resources and things that are going to help them go to the next level? And I don't mean necessarily growth next level, but understanding of what it is to be a business owner, understanding what it means to deal with the complexities every single day of growing an enterprise and a practice, not just delivering advice to clients. And so I do think there's great risk to advisors. You said 25. I think less than 100 million, candidly. That as the biggest firms in our industry continue to scale, the warehouse firms, not dissimilar than the wirehouses of the olden days, so to speak. I think there's a great risk to those advisors that they're going to be allowed to participate in the utility experience, but they're not going to have a voice to see at the table. They're not going to really have someone that's going to pay attention, and they're going to be asked to follow the rules. And as long as they do that well, they'll be allowed to be there. But if we're candid, the economic quotient they provide is nominal. It's like dropping a pebble into an ocean to some degree.
Is a tiered support structure and service degradation, is that a real problem for these advisors?
I think that becomes a risk. I can't say I know specifically today that it is. Certainly when we talk to advisors that are below 100 million, as we typically do, that's a area that we have incredible strength in supporting and serving, because it is for us about who they are and what their dream is, not how much they produce today, and being growth minded. I do get the sense that they are suffering a little bit for sure. But I also get the sense, candidly, that even those that are bigger than that are suffering in some of these places as well because of the constant change, the constant turnover of staff, and how you then solve service problems at scale. It's not an easy thing to do.
Yeah, you've said this before in past conversations I've had. Is you in that situation, it's hard to solve problems together.
Right. Problems, I would say it's impossible to.
Right. I mean, problems are in many ways solved for you if they truly are solved.
Yeah.
Where and maybe that's good. That might work in some cases, but they're certainly not solved together. Right. They have to be solved. When you're that big, they have to be solved top down because they just can't do it with 30,000 advisors. There might be.
And candidly, because. And again, I don't know if this is fair, but I'll say
we're painting with a broad brush.
And so I don't know if this is for what I'm going to say next, but firms that are more economic quotient driven, publicly traded, private equity owned, the impetus of that is the economic investment that's been made, right?
Sure.
And the return to shareholders, the return to investors. If you're leading those firms and you have to deliver service at scale, it just has to get less personal.
Yeah.
There's just that's the outcome. No different than I can't call Verizon to talk with someone these days. I got to go on my app and talk to the chat bot
Go
kind
through
of thing.
10 prompts to get the
Exactly.
Yeah.
So I think that's for advisors that we tend to do an incredible job of serving. Again, those less than 100 million, looking for a partner, looking to unlock kind of from within themselves how to actually go pursue ownership of and be enterprising.
Sure.
I think they're at great risk.
But if you want hands off, then that works.
Yeah, sure.
And there's a lot of advisors that love that, and that's perfect for them.
Yeah. And then that's independence, probably the best way it could be in our industry.
Sure.
Understand that we're probably not actually independent. We're dependent, as we've talked about in another episode. So,
You actually gave me a pretty good segment, the next thing. So if you're an advisor thinking about moving, right, and how should you think about firms that are private equity backed, right? Or many are publicly traded, obviously, but private equity backed, publicly traded. What should that thinking look like if you're an advisor?
Yeah, I'll say more on the private equity side than the publicly traded. I think that you just have to expect change that you're not in control of.
Yeah, sure.
That you're going to get an announcement at some point in time that ownership has changed, and with ownership changing, who knows what that means in the context of the business model, in the context of what will or won't be the same, what might become different, those kinds of things. So, and don't get me wrong, I love American capitalism. Private equity plays an incredibly important role in our economic systems. I think it's not a bad thing it's in our industry. I think it's a great thing it's in our industry. But the key point is advisors have to kind of be eyes wide open about what the implications of that are. I was at a conference a year ago, and I was on a panel talking about that very topic, right? And one of the other panelists said, they won't even talk to an advisor unless you're doing $1 million in GDC. Mm-hmm. And there's nothing wrong, good or bad about that.
That's the business model.
That's their business model.
Yeah.
But the point is, what they're basically saying is that you're only valuable based on an economic quotient, and if you're an advisor that does less than that, we're not interested in you. You don't move our needle enough.
Yeah.
And I think that's unfortunate. There's incredible advisors doing half that, 3/4 of that, 1/4 of that are growing, that are right minded, that are doing incredibly great work to serve people. But I get it. Their economic model dictates that the only way that they're going to get the private equity returns they seek is by focus on those in those areas.
Yeah, and those advisors who aren't doing it today could be doing that and more tomorrow.
They will be.
Given the right support, right?
Yeah, as you know, we would love to work with those types of advisors and help them grow businesses that they look back and have doubled and tripled in 5 and 10 year periods and those kinds of things. Yeah, so
we've done a number of transitions, obviously. Capital concerns, short-term things advisors need to worry about when they're going through transitions, long-term constraints they need to be aware of. What advice would you give to advisors? Think about those things.
Yeah, I would say that the industry, and maybe this is a bit of a biased perspective, but I think our industry has trained advisors to focus on their economic value. Mm-hmm. And the reality is, if they go grow a business, that's great. They're going to probably make plenty of income. They're going to own an asset that's transferable someday and monetizable. Yeah. Most excellent advisors that grow great practices are not going to really have personal economic issues long term. And so the question becomes, is the kind of like the shot in the arm of an initial some sort of transition package or thing like that check worth what it means in the long term relative to you're stuck. You've agreed to be there for a certain period of time. You're accepting the rules as they've been laid out and don't have any control over how they might change versus a partner. And I think like founders who will invest in a transition with an advisor, make sure they're whole through it, and then go help them grow something that on the back end maybe might end up being more valuable because of the direct agreed and chosen influence we have on each other, authority we've given each other, and partnership we've done to help them to grow a practice ultimately.
Yeah, it goes back to what you said. It's what's most important, right? So if the capital concerns are really important, then that's a consideration. But there is
a legitimate one.
A legitimate one.
A legitimate one. I mean, these transitions are hard. They're disruptive. I cherish and I'm very thankful that when a person decides to join Founders, because what's interesting is, the burst of excitement and momentum in that moment, it's like dropping a rock into a pond. It has this big splash, but that's not what's lasting. That dissipates quickly. It's the ripple across the pond that makes the big difference. Yeah. And so I feel nothing but honored that we have people willing to go through the disruption of the splash to seek what the ripple effect a member partner founders can look like. And so back to the question, so then what's the mindset of an advisor? If I were the one making the decision for my practice, I would focus no different than I do for my clients, the long term versus the short term. We train our clients all the time that the disruptions, the things dropping into the ponds every single day, or that cause market dislocations and economic dislocations and political dislocations, don't worry about those. I would give advisors the same advice. Don't worry about the splash. Focus on the partner that's going to help your ripple be lasting and be stronger, if that makes sense. I don't know if it's a good analogy, but a way to think about it.
Yeah, but it's again, if you value that independence, right? Yeah. Then that's also part of the consideration, right? Because as you've said, you take that big check, you maybe forfeit some of that independence in the process as well.
And I think what's interesting about the kind of the big transition packages that we see on headlines all the time is, back to this idea of business ownership. Do advisors take that money and actually go put it into their business as capital, a capital contribution, and use it to then invest in technology, people, resources, growth strategies, or does it just make their net worth higher?
Yeah, you go to investment account, right?
Because they're probably already living pretty well. They probably have nice lives and those kind of things. So it is interesting to think about that too. Like, what are they actually doing with it? Other than it feels great, that shot. Again, that shot. Those are the things that if I was an advisor thinking about this, I would really challenge myself to consider. And again, I'm not saying that because it's not important and it can't be impactful. I'm saying it because it doesn't necessarily mean it's right. Yeah. Human condition is just because you can doesn't mean you should. Yeah. Kind of a thing.
Yeah, exactly.
Yeah.
All right. So I'm going to put you on the spot here. If you were sitting in front of an advisor right now considering moving firms, what would you tell them to think about? What advice would you give them to say, think about these 3 things or these 5 things?
I think I can sum it to one thing, actually. Okay. I would ask them that, what do they want their enterprise and their life to look like in 20 years or 10 years or 5 years, depending on what their time frame is. And then based on that answer, then you kind of get to work back a little bit. One of the most valuable exercises that I ever undertook here at Founders was, thinking about that in the context of our organization's long-term picture and setting a destination versus just incrementally moving towards something. And so is your goal to retire or not? At what age? How important is the monetization? How important is the continuity of your care of your relationships? Like, what does the end look like? And if you can see clearly what the end looks like, it gets a lot easier to then assess what is required to get there, if that makes sense. And so if I can understand that from them, I can help them better understand how Founders or any firm they would be talking to can be the partner, the conduit, the utility in some cases to help them get there. So you understand that point, you understand what's most important to them and why, and it gets pretty clear pretty quick on how to make the decision.
Yeah, then you get into like technology and
and so again,
and all the
and notice I didn't go there with the answer to your question because my view is those are the commodities of our industry. Yep. And Founders, anybody else's, isn't that different.
Sure.
We all need to deliver great client experiences through technology. We all need to run our business effectively through technology. And the disruption of fintech, AI, all that, again, I've said this many times, it just has flattened that. Those aren't massive differentiators anymore. Yeah. There's subtle differences. So, for example, if I'm an advisor and there's a planning software that's critical to me, or there's a CRM that's critical to me, these foundational points of my firm, and the firm I'm considering can't support them, well, yeah, those are probably deal breaker moments, right? Sure. It's hard enough to make a transition, let alone I'm going to transition planning software, CRMs, all this kind of stuff, right? And so, again, destination in sight, understand what's most important to them and why, and then once you've done those things, getting into the details around what they do to operate their enterprises, how they organize their enterprises. That's when you can really then assess
It's digging into the details.
Where's the right match, and could founders be the right match or not? And we're perfectly comfortable telling someone the or not if that truly is the right answer.
Yeah.
I've said this many times, no different than advisors or fiduciaries to clients. We're a fiduciary to advisors. It's not our job to recruit them here. It's our job to explore with them common ground and what's possible through this relationship. And if that's motivating to both of us, yeah, giddy up, let's go. But I'm more than happy to also be the person that says we're not right, and here's where I think you might go look, because of what you've told me the answer to all these questions are.
Yeah, I think that's a great place to leave it. Brad, thanks for joining us again and having a great conversation.
Yeah, Steve, thank you.
Excited to have you come back and talk some more.
I appreciate it. Look forward to it.
All right, thanks.
All right, thanks.
Thanks for spending time with us on the Built by and for podcast. If this conversation resonated, follow the show on Apple Podcasts, Spotify, or YouTube, and share it with an advisor in your circle who's thinking about what comes next. To learn more about Founders Financial and our solutions for independent advisors, visit foundersfinancial.com. The Built by and for podcast is produced by Founders Financial. The opinions expressed by hosts and guests are their own and do not necessarily reflect the views of Founders Financial. Content is for informational purposes only and is not intended as investment, legal, or tax advice. Securities offered through Founders Financial Securities, LLC, member FINRA and SIPC, registered investment advisor. Copyright Founders Financial, all rights reserved.